All right, everybody, welcome back to the Sherman Show. We were on hiatus for about 4 months looking for a new guest, and someone stumbled in our office today that we thought was worthy of another podcast. So welcome, David Zervos.
Great to be here.
Yeah,
Thanks for having me, Jeff.
And for those who don't know, he's the chief market strategist over at Jefferies. He's got his Jefferies swag on today, trying to compete with us here with our double line swag. And the one sad thing is we don't have Sam Lau here today. So I have a different co-host today who is actually Sam Lau's other co-host from the Double Line Minutes podcast. So Jeff Mayberry, welcome back to the Sherman Show, this time as co-host.
Thank you. Those of you that are Sam Lau fans, he'll be back. I'm trying to do an adequate job.
Yeah.
Not great, but not too bad.
That's Sam's goal, is to retire from everything we do, and so he's the one that put us on hiatus. So without further ado, welcome, David. Well, it's Zervos. We all know you as Zervos, right? Yeah. So welcome to the show, and let's just jump into it.
Sure.
So it's been 4 years since you've been here. Nothing's changed, right? Markets, they always go up. There's been some turmoil out there, and Jeff was doing a little research this morning by listening to our old podcast, and one thing we were talking about at the time was Jay Powell and what a disaster he was at the time, because this was, April of 2019?
2019, yeah.
Yeah, and so we remember what transpired in the fourth quarter of 2018. So catch us up to speed. What's happened in 4 years? What's changed with Jay Powell, if anything, and what's your assessment of him today? It's a big question.
I mean, those are great questions, and to be honest, I get pinned a lot these days for being too easy on Jay or talking about how successful Jay has been in dealing with the greatest inflation shock of our careers. But people often forget, in 2018, I was pretty aggressively pushing back on Jay, in particular when he had that, I think it was Judy Woodruff that he spoke with in NPR in August, September, October, when he said we're a long way from neutral, and just proceeded to keep hiking into Q4 when clearly the markets were choking and the inflation story was really going the other way. We weren't anywhere near the target, and we were heading lower.
We had the automatic pilot thing of the balance sheet runoff. I mean, he was just ignoring all the signals. And if I recall at that time, too, most people were talking about how great Jay was going to be because he was a credit market person. Right. He listens to the market. And he was definitely not listening.
He was not listening. I think he was getting caught up in politics. There's no question that the Trump antagonism toward Jay was building. I do believe Trump referred to him as a bonehead on at least 2 occasions, maybe 3.
I mean, that's not a bad phrase from him. I mean, from some of the stuff he says, bonehead is not one that
I heard Jay speak at a conference, and I think it was Becky Quick asked him, what do you think of, when if he wins again and you got to be there, and this guy called you a bonehead, and I think Jay said, well, I think he called me a bonehead a bunch of times, and actually I think he called a lot of people boneheads. I really wasn't very special, so I don't pay attention to it. So he pushed it aside, but I really do think there was a sort of political turf battle about that 2018 period where he didn't like the infringement on independence or being seen as someone who could be pushed around like Arthur Burns or Bill Martin, and stood his ground, and kind of it was a bad time to stand your ground. It just didn't make sense economically. And you'll probably also remember that I was going on a few TV shows every once in a while, and they were asking me about my hair, which was, I think back then yours was pretty long too. And I was doing my protest, which was I'm not cutting my hair till the Fed cuts rates. Right. And then July 31st of 19, we got the haircut and the rate cut.
I watched it on TV too. It wasn't live per se.
No, we did
it
a couple
definitely
of
happened.
buzzes,
Yeah, they did a couple, but I was like, then people were asking me about it. No, that was Zervos' thing.
Yeah. It was close though. Yeah. You could have been up there easily. So I do think Jay's come a long way. I think Jay evolved from that experience in a positive way, and I do think what he did in response to the inflation shock gets a lot of criticism, and I didn't really participate in that criticism. I thought I understood what Jay was doing in 2021. 2021 was, again, I don't want to harp too much on politics, but politics matters. Jay was in the middle of a renomination.
Yeah.
And for him to go and start saying, okay, Q2 of 2021, inflation's spiking up. We're all looking at these 0.9s on CPIs going, what the hell are those? I haven't seen a 0.9 month-on-month CPI. I mean,
and then they got one handles.
These
are month over month.
Like,
yeah, right. Yeah.
What are we, Brazil or Argentina? And then the transitory stuff came in, and he sort of just kept playing the Janet Yellen cards and being close with the administration, not being confrontational. And he got what he wanted, which was the renomination. And I think they really didn't want him necessarily. I think they'd be much happier if Lael Brainerd was in there or someone who was closer to the Democratic Party for this next election period.
Right?
So I mean, I think Jay played his political cards beautifully. He hung out. He waited. And then when he saw the inflation sticking around, particularly Q4 of 2021, when it spiked back up again because it lulled a little in Q3, he just started getting busy, and we saw the liftoff in March, and then the sequence of 75s, 4 75s in a row, as expectations look like they might be de-anchoring at the beginning. And since then, he's just held the anchor. We haven't seen the 5-year break-evens move up above 250 in any meaningful way for a sustained period of time. They basically have stayed in a range throughout this entire experience. The Michigan survey, the New York Fed survey, the shape of the curve is an inversion. I mean, everything just suggests that these guys have credibility, and Jay built that credibility and kept it. So as much as people want to beat on him and say he didn't go soon enough or he could have started 3 or 6 months earlier, he could have. I think he might not have had a job if he did that. And I don't even think it really mattered to the inflation experience that much, because what we've learned about this inflation experience is that it just has so much more of its storyline rooted in supply side. And so the moving demand around was kind of just to make sure inflation expectations didn't de-anchor, which he did. It didn't really move the needle on either the fighting the inflation surge up, and I'm not really sure that it had much to do with the disinflation on the way down. I think that was just the unwind of the supply shock.
Wasn't it just really all about the goods, really? And it was a supply shock, and it was really the good side of the equation. And we've seen the reversal of that, and that's really – I mean, granted, there's a little bit more, there's a little bit more inflation there today. But, I think, we would say the same thing. He's done a pretty good job, and – look, he's done a great job with his mouthpiece with Tim Morose out there, too, of getting those 75s in when he needed to, right?
Really good.
That was really good and set the market up for it. It was painful to the bond market. But let's rewind the clock a little bit. Let's go back into, March of 2020, and let's talk about some of the behavior that the Fed did there, too. And Jeff when he was doing the research, he found, that you had said in the last podcast, and, man, we're digging in the annals of history here. But talking about the Federal Reserve Act and Bernanke getting creative during the GFC. I think a lot of us would argue that Powell got very creative in March of 2020. How do you think about that? And does that change your kind of the reflexive mechanism of the Fed going forward when we see, let's call it a more typical type recession? That is, do you expect them to buy corporate bonds? Do you expect them to do some of these policies? Because you've been very vocal about the interest rate policy is separate from the balance sheet policy. How are you thinking about that going forward? And do you think that Powell set something up differently by the behavior in March of 2020?
Told you a lot to unpack there, but great questions. Great questions. There's a lot to go through there, because first let me say that if you go back and you look at the Fed's assessment of its success fighting the global financial crisis, there was a Brookings conference in 2019, I think in the summer. What have we learned 10 years later from the crisis? And you had Hank Paulson and Ben Bernanke and all these officials that were in the Fed and in the Treasury, few academics. And basically there was the minutes of that Brookings symposium basically said the following. If we had to do it all over again, we would have gone bigger and we would have gone earlier. Mm-hmm. That was, and Lael Brainerd wrote that. And so you kind of knew how they would react if something bad happened. They sort of told you the put structure. The put structure was, we did a lot in the end, but it took us a while to do it. We had to do QE1, then QE2, QE3. We were a little scared. Lots of people were criticizing us.
Cash for clunkers.
Yeah, exactly. CPFF, AMLF, TALF. I say we FF'd everything. Didn't mean anything we didn't like to FF. Right. So I think when March of 2020 came along, the ammunition was all lined up, right? They were all ready. They had built the infrastructure to go in to every market, the muni market, boom. Mm-hmm. The corporate markets, they had set it up. They built it. They knew what they wanted to do. This wasn't sort of flying by the seat of your pants like Ben sitting, in 2008 going, oh, my God, the CP market's blowing up. Let's create a commercial paper funding facility. It was we're just going to go in and do everything. And March 20 of 2020, they brought that bazooka out. That was the bottom in the stock market. The financial conditions were basically underwritten by the Fed as we went to fire 22 million people and shut the economy down. And really, I think they look back on that. They look back on that as a success. I do. I think there was a period when inflation was pushing 9% in the summer of 22 where they go, geez, I hope we didn't have that much to do with this and that these policies were not too stimulatory to demand that we're getting there. But look, our big argument on the inflation and the deflation, I think you guys have been in this camp as well here, is that most of this was supply side. A lot of it was supply side. There's been a paper by Bernanke and Blanchard that I think was pretty good highlighting the supply side, even though they bring the demand side back in later. I think the Fed's going to look at this going forward as we've got tools. We can use them. We know how to use them when crisis hits, and we're not afraid to use them. The success that they've had in getting inflation back down to 3 to 3.5 on CPI, below 3 on PC, is giving them greater and greater confidence. I will say, and this is why your question is a little tricky, there's really two ways to cut the balance sheet. There's the let's go in and do massive large-scale asset purchases, QE, buy treasuries and mortgages. I sort of feel like that's going to be more on the back burner. That's the kind of thing where, okay, we get to the zero bound. We got to do this. It's the only way to stimulate. What I think they're really feeling successful about is the BTFP or what the UK did in the gilt market in October of 2022 or what the ECB did with the TPI, the Transmission Protection Instrument.
So the liquidity facility is what you're talking about, right?
Go in and say, okay, there's
not the FFs, but liquidity, the LFs.
The sort of coming in going, okay, there's a problem in commercial real estate. That may metastasize into something that that tightens up financial conditions, seizes up, closes the high-yield credit markets, whatever. Let's go in and just create a CMBS TALF structure or some sort of funding structure, liquidity structure where people can deliver the super senior parts of the capital structure of commercial real estate into a Federal Reserve facility, get funding on them, and basically stop the rot at the super senior level, right? And that's sort of what they do with all these facilities, right? They're
what
not
happening in the mortgage market, they're not the residential side,
right? They're not going to bail out the equity guy. They're not going to bail out the mezzanine guy. They're going to say, give us the asset. We're the asset holder. We'll fund the asset at OIS plus 10 or OIS plus 50 or OIS plus 100, whatever number they want. You can give it to us for a year, 2 years, 5 years, like until this liquidity situation is over. If it becomes a solvency issue, which it always could become, they're going to have to eat that with the Treasury. That's kind of what these facilities end up doing. Now, we haven't seen that. They made money in most of these lending facilities. So I think that's where they're probably feeling the most power and where the balance sheet put structure that the Fed introduced to us through QE and then through the funding facilities and liquidity facilities, the sort of evolution of that put is that it's become and will likely continue to become more targeted. So I'm not as excited about the Fed re-entering large-scale asset purchases in the mortgage market. I think that may be something that really doesn't happen again in our careers, and that these targeted facilities become much more of the methodology for putting out recessionary fires. And then large-scale asset purchases and treasuries can be used and will be used. And that becomes more of a fiscal policy, how are we feeling about the debts, deficits, the size of, the management.
Well, on that front, too, like if you think about it, at first, I think the reason they bought mortgages, one, there was obviously the issue with the housing market was shut down. They wanted to make sure Fannie and Freddie were still operating, right? It wasn't just a Ginnie Mae facility. But I think over time, I think initially also, they didn't want to be Japan and own so much of the float of treasuries. Now maybe with the budget, maybe they're thinking a little bit more that direction. Maybe that's the whole reason that maybe mortgages won't be there. But just real quick, too, when you're talking about this, there's one thing that we also created in 2020 I think doesn't get a lot of play, and that's we learned the transmission mechanism from the banks, how to put money in people's accounts.
Yeah.
And that was a thing that was kind of missing as well in this version of stimulus. So before I let Jeff ask any questions, let me get one last one in here, and that is on setting up this ability to get money into people's hands quicker, not corporations, not funding facilities, not large-scale asset purchases, but direct to consumer, right? Does that change the operation of how we think about it too from our fiscal authorities? Forget the monetary side because now we kind of have that plumbing set up from the banking system to be able to kind of dump that money in people's accounts much quicker.
So I think we've always had that there. We've seen stimmy checks go in other time periods, and certainly other countries have done it. I think the Australians gave everybody like a $2,500 Christmas bonus one year, and when things got messy.
They were also talking about borrowing against the superannuation funds to fund your home purchases, but that's a whole different issue. But anyway,
I don't ever see I think the architecture is built to send money to people and checks to people. We can always do that through Treasury. It's whether politically it can happen. The one thing we've seen with the Fed is when the politics gets in the way of stimulus, which it almost invariably does in a crisis because you're pointing a finger and saying, that's a bad bank, that's a good guy, this is poor this guy, bad that guy, and you don't want to reward bad behavior. It just you're in the middle of a crisis and you're like, okay, we got to do something, and Hank Paulson's on his knee in front of Nancy Pelosi going, I need to do something, and you've got this other thing called the Fed where 19 guys sit around a table and decide right then and there we can dump liquidity in at a moment's notice. Like we don't need to go to Congress. So I think the architecture's there. I do think, look, there's still going to be massive political divides on cutting checks and giving them to people. Whether this one was easy, it was a pandemic. We let 22 million people go. They didn't have W-2s. So all of a sudden 22 million W-2s disappear. And you go, okay, well, I got to give these guys some money.
And don't forget, they're all elected politicians, and so those people will be revolting at the ballot box.
100%. Right? So I think that was an easy fiscal stimulus. 2008, 2009, people who had, 5 condos in Las Vegas and were levered to the hills, it's like, did we really want to bail them out? Did we want them all to, ride this property wave that they had ridden for all those years? I think it was a lot harder to get the fiscal behind that. So behind the scenes, the Fed had to be kind of helping, but making sure they were helping this sort of the good guys, if you will, or the super senior parts of the capital structure, not the kind of people living on the edge of that. I'm going to be less focused when I think about markets on how the fiscal comes into the next downturn because it's always so slow and complicated. The usual thing that gets us going and gets spreads and equities and risk assets in general and treasuries moving is kind of how the Fed's immediately responding to the liquidity crisis or the solvency crisis that's hitting us in a time of stress.
Makes sense. Yeah.
So I'll probably still be thinking about that balance sheet, what programs they put in, and how they're going to think about the next iteration of what QE looks like when we do it again. And as I said, I just think mortgages might be out of that game for a long while. And I'm not sure it's a terrible story either. It probably was something that served a purpose, particularly in 08 and 09, but maybe didn't serve a great purpose in 2020 and 2021.
I kind of feel like it was just that they did it before. It was still somewhat quasi-government guaranteed, so they're trafficking in the same realm.
Yeah.
But then, again, when they opened up the Pandora's box of the corporate bonds, I think it's back to what you said. It makes a lot more sense when you compartmentalize of all these funding facilities that we've had, that we have targeted certain parts of the market. And maybe we're a little disgruntled because we were underweight corporate bonds at that point in time. We're long all these other parts of credit markets in the senior parts that didn't get the support. So maybe that's still wearing on my psyche a little bit. But it's been 4 years.
Yeah.
You got to have some scars.
Come
You got to
on.
have some scars through these crises. So.
I mean, how much of it was that they bailed out mortgages last time in the financial crisis, and now it's like, we don't want to do that again. Let's bail out corporate bonds. So is it next time they're like, I mean, they have the facilities, so it's probably easy for them to just flip the switch. But is it like you said, kind of, commercial real estate or commercial mortgages? Like that targeted side will be something that is more politically feasible if they didn't get the bailout last time.
Look, I think all this stuff becomes more politically palatable and feasible, like the BTFP, which, on the face of it looks like a crazy program, right? I'm advancing you 100 on a $70 price bond. Like, who gives 130% advance rates?
Jefferies doesn't do that.
Like, we're not going to give you. We don't give you 130% on repo. You're a great friend. You're a great firm. We love you, but you're not getting 130.
It's not a good business, right?
It doesn't make anybody any money, and it promotes bad behavior.
Yeah, fair enough.
I think didn't Lehman have the Repo 105 thing?
Yeah,
remember Repo 105?
Yep.
We haven't talked about that in a while. I was like, I'm going to give you 105 for every 100.
That
didn't work out well either.
That was like the negative amortization loan. It just doesn't work out very well.
We're doing like Repo 130.
Yeah. Right.
But behind the scenes, the reason I think that was palatable and it made sense was we were wiping out equity. We were wiping out bad players, right? We saw banks like SVB, their equity and their prefs gone, and a whole host of others. So in a way, what we were doing is kind of going back to the senior part of the capital structure, saying, okay, we'll backstop the senior part of the capital structure, but we're going to start wiping out like the guys at the top of the capital structure that had the bad business model. And as long as you're doing that, I think you can target these programs into commercial real estate, municipal bonds, and others.
It still reeks of capitalism, right?
And it does reek of picking winners and picking losers, which I think is the biggest kind of criticism of being in the agency mortgage market in QE. It's like, why am I helping agency mortgages and I'm not helping IG corporates? I mean, why are and by the way, they were the ones that kind of were the reckless ones leading up to 2008 as well. So I'm bailing. So I think you've got to find a way to backstop financial stability in these sectors without looking like you're giving back too much to the recklessness that got you into that financial stability. And I think, to be honest, all these programs, whether it was the gilt program in the UK or what was done with the ECB with peripheral bonds or the BTFP, they've done a pretty good job of I think, not rewarding reckless behavior and trying to backstop financial stability. They're still iterating on it, but I think that's going to be more of what we see. And look, if you think about where the next crises are going to come, it's probably in places like PE and commercial real estate. Those are the two areas that have gorged on zero rates more than anybody. Whatever assets are under pressure there, if the Fed can come in at the senior level and put some sort of funding on that, term funding on that the market's not giving, then that'll find a floor, and then we'll be able to write down all this stuff and not see it create a forced selling liquidity event.
So on that, how do you do that in private equity, private credit? Because I can see it on the commercial real estate market, which is functioning today. Obviously, we haven't wanted it because we've loved the AAA stuff in CMBS. So we've been gorging on that stuff for the last year and a half or so. It's been great, by the way. Maybe it got a little tight as of late, but I can see that. But I struggle with this connection with the private credit world. And, I guess the Fed has the inner workings. They can see it, too, because they obviously know the banks, too, right? Yeah. So they're supposed to know the banks. They're supposed to know what's in SVB and the likes. So how does that look if you're thinking through it, too? And how do you do that without casting that black eye? Because it's thought of as the cowboys are in the private markets, right? Rightly or wrongly.
Yeah. Well, it's true. It's opaque. It's not mark-to-market. It's a
feature, not a bug.
Pretty transparent. Then again, I mean, look, a lot of bank portfolios aren't mark-to-market or insurance companies. I mean, they mark on accrual basis, and that's what gets them into trouble.
Right. As we saw.
So it's not that different than the private markets.
Sure.
I mean, from a marking perspective.
And some would argue that's what's happened also in commercial real estate. Yeah. It's the same thing, right?
Absolutely. Yeah. I mean, look, people are still pretending valuations are there based on rates that they could have gotten 5 years ago, and they're just waiting for the lockup to end, and then they're going to realize, okay, that's not the rate, and the value of this thing is down, and we're going to see more buildings like the one at 56th and Broadway trade, down a lot. That's equity getting wiped out. Look, I don't know. It's hard to game a sort of policy intrusion into private equity and private credit. I think the way I always think about it is bigger picture. You can deliver an asset like the TALF program. Like we deliver dealer floor plans. You could deliver your dealer inventory of cars to the Fed. Yeah. Go, here's my cars. Here's what I've got all these cars. They're not going anywhere. They're yours if I don't sell them, but I need money.
Yeah. I remember during 2020 when we were having our credit calls and everything, and they were talking about like the airlines and they're selling off gates at JFK, all these unencumbered assets. And one day Gunlock goes, well, did they find any unencumbered peanuts that they haven't pledged yet? Like it seems like every week there was a brand new thing they were pledging.
Find a new asset.
So we're trying to figure out where those stale nuts were too in there. But you're right. It's like you said, dealer floor plans and the like. It's that they get creative, right?
It worked.
Yeah.
And look, anything can go to the discount window for banks, right? I mean, you can show up at the discount window with like a pink slip for an old Ford Explorer, and they'll put a price on it, and they'll give you cash. That's the nature of what the discount window is. It's anything and everything. So I don't think that we have the infrastructure to do it if we want. And with private assets, it's just a question of, haircutting the valuation and knowing what the asset is. And we did that with TALF. I mean, if TALF really was an experiment of entering into the private sector and going, okay, I'm gonna put valuations from, a variety of sources on these assets.
And it was asset backed. It was commercial.
It's always got to be asset backed, right? If you think about that, they've always got to lend against.
It's got to have something underlying collateral.
You're not going to walk in with uncollateralized.
The unencumbered nuts probably aren't going to work.
Yeah. So maybe it's I don't know. Maybe you feed a country with it. It's a good idea.
Yeah. These are things that go on at the double line investment meetings. We talk about that. So,
if we kind of go back to Jay Powell for a second. Is it more his communication obviously has improved? Is it more like he's just gotten used to it, or is he more like I wrote in my notes indoctrinated just in the FOMC way? Do you think it's that or kind of both?
I mean, I don't know that his communication skills have evolved like anyone that does a job and works at it. They usually get better at it. I mean, there's certainly that, but. I look at the evolution from what happened in 18 and 19 as more of, he really got caught up in the politics of the time and tried to stand his ground at a time when economically that wasn't a very smart thing to do, and he looked kind of foolish by doing that. And we came out of that, and he switched in January of 19. He started cutting rates, did 3 rate cuts, got us to a nice equilibrium.
I joked that it's because he got the masters around him too. He had Bernanke, he had Yellen, and he was like, "Oh crap!
Yeah,
I've made a mistake here. Let's get the OGs involved, right?"
Yeah. You know what's so funny is I Trump never kind of sort of did the "see I told you so" thing either to him, which I sort of thought he would at some point. Which it just sort of went away, and. He gave us the rate cuts, and we all kind of rode into the end of 19 feeling pretty good. Yeah. I mean, I felt pretty good. I felt like, wow, this is the new equilibrium is 2% yields forever. We had a 2% 2-year note, we had a 2% 10-year note. Real
1.5% inflation.
Real rates are 0. Inflation's at 1.6.
Yeah.
I was like risk parity, let's go. And I remember we doubled up the hedges on the fixed income side. I used to run for every 100 million of S&P, we'd run $100,000 a basis point in blues or twos or whatever rhymed with spoons.
Chartreuse.
Chartreuse.
Yeah, right. I remember that.
Long time reader. But we did $200,000 a basis point. So I was like, all right, they're going to go big or go. They're going to go if there's a problem, and I predicted a pandemic, but whatever the problem is, they're going to go big and they're going to go early. So I got 200 basis points to play with. That's 20% if we go back to 0. That's not enough to protect me in a cycle. I need more. So we did $200,000 a basis point. And thankfully I did that because in March of 2020, you needed that. We had a 36% drawdown.
And in the summer, you changed it
to corporates.
And we were like, what are you doing? What are you doing?
JP Morgan, 2-year notes at like 3.5%.
Right.
Like, let's go.
Let's go. And it worked. It worked brilliantly, too.
Yeah. But, that was because of what you said is they told you corporates are now in the put.
Yep.
Right. The put now became comfortable with the backstop not just being guidance, which is blues, or outright rates, which is short end like 2s. They're going to go in and they're going to do high grade corporate bonds.
But you don't feel that way today, though, right? I mean, now that we're closer to 4 years removed from that, doesn't it seem like that is removed and maybe it is something different? The evolution of the TALFish toolkit. We keep using the word TALF, the acronym TALF. That was the Trouble Asset Liquidity Facility from 2009, where a lot of stuff got pledged into. So whenever you talk about it's a troubled asset, that's hence TALF. But do you still feel that way about corporates, or you kind of question that, and it has to be where we are in the cycle and what's causing the problem?
It's a good question. I look, this year we've gone back to our much more traditional risk parity views with
rates,
with SPOOs and blues, because I got 400 bips in blues or 350 bips. That's a lot of insurance. I haven't had that kind of insurance in a while. I feel really good about that. I got put into corporates because I kind of ran out. Right? I got to the zero lower bound of risk parity, right? So it's like they run out of it as policymakers. I run out of it as a hedge, right? So you improvise, and that's our version of kind of getting to a portfolio you can be comfortable with that has insurance in it in a zero rate environment. I guess what's my evolution now, and this might be a segue into further topics in the discussion. I really think we're going to be in a higher equilibrium rate world for a while. I'm coming to grips with it, and I like it. I'm really excited about our star at like 3 or 3.5.
What's called positive real yield. I mean, this is something we used to have back in the bond market.
Isn't it great?
Right? Yeah,
don't you feel good like at night?
Back when you were actually doing policy, we used to have this, right? So on that note, let's talk about that, because the mantra is been higher for longer. I hate it, by the way. It's like, it's just positive real yields. Yeah. What's wrong with that? I tell the desk every day, enjoy it. Yeah. Enjoy it. We were in the dungeon forever. That's what Gunlock calls it, the fixed income dungeon of zero real yields or negative real yields. And now you get it again. And so, why is the Fed so eager to want to cut? Especially given some of the data we've seen there. The bond market seems to be bullying it. Risk assets seem to like it. But outside of that, why are they so eager to demonstrate that?
I'd switch the question around on you, because I think the market has been so eager for the Fed to cut. And the Fed's kind of been like, hey, guys, we're cool. We'd like to get back to neutral and whatever that neutral may be. And we're kind of thinking neutral may be a little higher. We're not sure yet. Yeah. But they've been pushing back on the market. Remember, in the beginning of 23, the market was pricing in 50 bips of cuts. The Fed had a pretty dire forecast, but they didn't have cuts priced in. And in fact, they hiked 100 in 23. This year we had almost 7 cuts priced in. I mean, it was like unbelievable looking at like D-SOFR.
But
the Fed pushed back on that.
But didn't Powell create that back in October? And then
December's the pivot people really yell at him about. Yeah. They say he kind of really...
I thought he would slam the brakes in December. I was absolutely wrong. I was shocked.
I think December shocked everybody. Everyone was like, wow, this guy's really taking a victory lap here. Yeah. This is like... I'll go back to politics, because whenever I can't, it's, sort of like we have this thing called the risk premium. Like whenever you can't explain something in yields, you go, it must be the risk premium or the term premium. It's some premium that you can model that. And everybody's like, oh yeah, he's really smart. He's doing
it's the epsilon,
risk premium.
It's the error.
So for me, it's politics with the Fed. It's like, I can't understand why he did that. Probably he's getting political pressure. I do think Jay is navigating a pretty complicated political path going into this coming November, and was back then. I think he's got a lot of pressure from the usual suspects: Sherrod Brown, Elizabeth Warren, Maxine Waters, all the ones that send him letters all the time saying, even a year ago that he should be cutting rates, which is ludicrous. You're killing the job market at a 3.6% unemployment rate, or 3.9 now. Back then, 3.6. But I think the pressure underneath, from Janet Lael, the administration, the discussions. I mean, he's in Washington. He's in meetings. He's hearing it from various senators, from various members of the House, from different committees, different conferences he's attending. They want easier policy. They want this economy running strong going into the election. What sort of backfired for them is that the economy has run pretty strong. It just created a lot of inflation. Yeah. And they're feeling like maybe we screwed that up. Like maybe we should have actually been arguing for him to knock it down so the inflation would go down. And even if the unemployment rate was at 4.25, they might be better off as Democrats with a 4.25 unemployment rate and inflation at 2.
Do you think if Jay cuts rates between now and the election, say it was 50, do you think it changes the outcome of the election, though? Do you think really? Because like with the lags of policy and where we are in the overall economy, does it even matter?
I think they're pretty much past the point. I think the point to do it would have been
The
like
December area, right?
Or to start this year.
Yeah.
And that was the window where everybody was getting pretty excited, and the data didn't cooperate. But I think Jay pivoting in December, look, it was a great quarter for inflation. There's no question that Q4, everything came out roses on inflation, just miss, 3 in a row.
The 3-month annualized, the 6-month annualized, they were great. Yeah.
And then every, high-frequency forecaster, the rents are going to come down and real rates are going to spike up and the Fed's going to automatically tighten this year because inflation's going to fall. You had all those articles about how, if they weren't careful, they were going to engineer that recession. And I think he kind of played to that, but he also played to, if he was hawkish, if he was sort of saying, no, like, guys, we need another 2 or 3 quarters to get comfortable with inflation really being back at target, he would have got an earful from the administration. So I think it was a good political play for Jay to kind of give us that dovish December. It didn't cost him anything, right? No one's going to look back at the history of Jay Powell's record and go, oh, yeah, he misled us in December. That's not going to be in the textbooks or the transcripts. It's if he would have cut rates.
Yeah. It could have been.
It could have been.
Yeah.
And he didn't do that. But he kind of, I think what he did is he kept the board very much feeling like they were in control. So the new members, the Biden appointees felt like, okay, yeah, we've got this. We've got some real chance to cut if we can. Got the administration, Congress kind of off his back. And then the data came out with the way they came. Or now he basically gets to take the summer off. Let's see this is 3 months of data minimum.
Right. You have to because because he always says, we can't just extrapolate this most recent experience. So, and you've had 3 months of kind of bad data, let's call it, or above expectations on inflation, and so it's got to at least just stabilize to go down, and you can't have a big miss to the downside.
It's 3 months minimum. And he kind of said, look, we sort of looked at 1 month bad, 2 month bad, we got 3 months bad. We had 3 that's. Now we have to change policy, and the change in policy is not that we're going to hike rates; it's that we're going to keep restrictiveness for longer. Yeah. Okay, that's it. So he's told you that the next 3 months, they're just. And if we get 3 real aggressive down prints, look, we could start to talk about a September move.
Yeah.
But that's probably the earliest you could really talk about it, unless there's a crisis, of course. Yeah. And then the November meeting is conveniently located 2 days after the election. Yeah. So, that's, then all politics are off.
Right. You can stick it to whomever's left, right? Yeah.
So that was well done on the calendar.
Yeah. That was good thinking, I guess, schedule that day. So when you look at everything, too, markets are pretty well priced. The phrase that I think that's in this one is Goldilocks we keep hearing.
Yeah.
First quarter GDP, disappointed a little bit. But I thought it was great with Jay's comment on stagflation. I don't see the stag nor the inflation. Loved it. I thought that was really witty. He's saying learning the job. I think he's doing great there. But, what changes the dynamic? Risk markets are priced pretty well. You've seen some earnings misses a little bit on the equity side, through some of the corporate earnings have been coming through, but nothing to get nervous about. So what's kind of your outlook from here, too? You still like the risk parity concept here?
I do.
As you said, you have firepower on the hedge on the bond side. For those that don't know the blues, those are Fed fund futures that Dave's trading there.
3 years out.
Yeah.
Which still price in, 3.5% to 4% rates all the way out till your eyes can see.
Which is kind of what people think our stars probably in the low to mid threes.
And so if we have a crisis, we're going to have to take that down to 1 or 2 for a little while, and those will rally accordingly and hedge your portfolio.
Yeah.
Is risk fully priced? Here's what I would say. When the Fed started hiking rates back in March of 22, that first quarter, I think the S&P was peaked at something like 4,800. That was around the highs. Yeah. And then we were going to get some hikes. There weren't going to be too many. Everything was going to be okay. And then Jay was like, pain.
There will be pain.
There will be pain. There will be pain. I love that line. Yeah. I think in that Jackson Hole in 2022, the word pain was like on the word the word thing where you see it. The word pain was like one of the biggest words. It was great. Yeah. So, and you couldn't do risk parity back then. I think the story of that I spend today to get me still excited about risk assets is that, we're still at 5,000, 5,100, 5,200. We're up. We're not even up 10% from where we were 2 years ago. And nominal growth, nominal GDP has been growing at a really, really healthy pace. And I always go back to the Buffett statistic. I always go back to kind of let's deflate whatever thing we're looking at nominally by how much income is in the economy. What is it? That's nominal GDP. That's expenditures. That's income. That's production. We have a $29 trillion economy. And each year, we're not growing at what we used to grow at, which was about 3.5%, which is 1 3/4 inflation, 1 3/4 growth. We're going to like 5, 6.
Yep.
And we were growing at like 8 or 9.
Yeah, last year was 5.9, right?
Yeah,
right.
These are big nominal growth numbers. So
which is kind of our magic to get through our debt problem. Right?
That's what devalues our debt. That's what revalues our assets. That's what naturally delevers us. Consumers are hugely delevered when you look at debt divided by personal income, personal disposable income, or GDP. Corporate's not as much, but it's just I kind of go back to that Buffett statistic of total equity market cap divided by GDP. How much is the asset worth, and do I have the income to support the value of the asset? I would look at the same in real estate. I would look at the same in any nominal variable. I even look at things like earnings and profits. It's a lot easier to earn $1 in a high nominal growth environment than a low nominal growth environment. So right now, inflation is a little sticky, but that feeds me into the Fed's got anchored inflation expectation, but nominal growth is a little sticky. So my tailwind for valuation is still strong. And as long as the Fed's kind of holding the anchor and everything feels okay, I almost like having stickier inflation for risk assets. I think it greases the wheels of valuation a lot more. So I feel pretty good about risk asset valuation. And I'm not in the sort of we lose control of the long end of the bond market. We have to go to 5, 6, 7, 8, 9%, and you have to take multiples down to single digits. I don't think that's a story. This has been the longest inversion, I think, since 1929.
So with that too, the Fed probably messed up a little bit. Well, I'll at least contend that they messed up with the average inflation targeting, right? I think that's the post-mortem is we're not going to do that again because it got a little unwieldy because potentially they were looking at that. Also, we've posited the idea that they probably wanted a 4% inflation rate. They wanted to make up for the ills. Who knows? But again, it was supply driven, so it's a different thing, and we all know that with hindsight. What do you think about? And this is something I've been kind of ruminating on: is the idea of bringing back the post GFC world where people were talking about nominal GDP targeting, the NGDP.
There's a lot of people that like it. A lot of people
because
like
you can take this balance. We don't care how it does, and it comes back. It popped out to me when you were talking about nominal growth and these Buffett statistics, and so
I think the academics are all over it and they love it. The guys that the more traditional monetarist types, the more traditional stalwart types that think about running being less cavalier with monetary policy. They worry a lot about fast nominal GDP growth. Fast nominal GDP growth speeds everything up. Everything. Yeah. And the reason the bears got so twisted up with all their calls on earnings and profits and collapse in the equity markets is that they forgot this wasn't a deflationary slowdown that was coming. It was an inflationary slowdown that was coming because of the Fed raising rates. And that is really good for earnings. And also the monetary
growth was so massive too, right, that we have to work through that.
That was part of the inflationary impetus. Yeah. So, inflation does a lot of things that get us in trouble, but it also solves a lot of problems, particularly for indebted societies and leveraged balance sheets. It delevers you. It devalues debt, and it pushes asset valuations higher. It's just the one thing you don't want as a risk asset holder is deflation. Deflation's a killer. Like, it just kills you. Yeah. Especially if you're trading a nominal index like the S&P future at 4,800. Inflation's kind of good for that. Yeah. It might be bad for other things, and it's certainly not great for the Biden administration if they've had 3 years of, cumulative inflation at 20%. That's hurting them a lot. Yeah. But that 20% inflation and that 26% nominal GDP growth in 3 years it just glosses over so many things that could have gone wrong with risk asset prices.
And that's the biggest political problem that the administration has is that it's that inflation, and it's not the year over year. No. It's the anchoring to post-pandemic.
It's the cumulative.
Or pre-pandemic prices. Yeah.
You think about it this way, Jeff. You look at the Trump administration, the 2 Obama administrations, over the 4 years, cumulative inflation was 7%.
In each of them, yeah.
And going back in time, you just didn't. You had a few that were like low double digits. You had to go to Jimmy Carter. Jimmy Carter in 4 years had 40% cumulative inflation over 4 years. Like that was a miss. That was a bad one. He's at 20, and he's still got 9 months left. Before January hits, or 7 months left, or data-wise, probably 9 months before we get the final data. I mean, inflation is basically 3 times what it was in any period that most people can remember recently. 3 times. Yeah. The inflation they feel every day, because we think that, inflation's back down to 3, everybody's happy. No, people still see that carton of eggs. They still see that, slab of bacon. It's up there.
Yeah, and it's anchored to the 19 price. That's just what it is because we have a line in the sand.
Yeah, that's what I remember.
Right? Yeah.
And it'll take 5 or 10 years to wind that out. Yep. In a weird way, I really want to go back to your inflation targeting, average inflation targeting thing as a mistake, because I really think in retrospect they are going to have to change the framework. I don't think they'll do it this time. This year's a framework change thing. I don't think Jay wants to be the guy that changes.
Not in the middle of this.
Not in the middle of this.
Right.
But 5 years from now, I think there's going to be a retrospective where, and if you look at the framework's really, I think, written in a crazy way, because what they wrote and how the true policy framework works is they are there to do average inflation targeting. But the only thing when they care about the past is that if they miss to the downside, they try to make up for the upside. But if they miss to the upside, there's no making up for past mistakes to the upside.
Right.
It's asymmetric. Right. It's a fully asymmetric
because they can't
framework.
take deflation, right? That's what it is, right?
Right. So they'll never, if we get 10 years of 4%, they will never make up for that past mistake. Mm-hmm. If we get 10 years of 0, they would make up that missed 2% every year.
And they did.
And they did. And they did. So, but, in a weird way, nominal GDP targeting does solve a lot of this. Yeah. It's not as clean as you might like it, but I think it's got a lot of backing. And maybe that'll be the framework, we end up passing off to the next generation of money managers and Fed watchers as you and I go off into the sunset in 2030 or 2035.
Well, you heard it here. That's retirement. Retirement starts for the 2 Jeffs and Zerba. Sam will still be here, though, because he didn't show up today, so he doesn't know about it. But before we go to the last segment, I think
got some hats, too. So
yeah.
We'll do those.
All right. So before we go to the last segment, though, I want to talk about kind of the risk you see out there right now. And what are people not talking about? You talk to a lot of your clients and you as a market strategist, what do you think is underappreciated today?
I think the 2 places where you got the most risk, we talked about it already, are the guys who gorged at 0 rates, gorged at that trough. Private equity, which has had the greatest run. You talk to any kid coming in, they're coming into the markets now, where do they want to be? They don't want to sit on a sales and trading desk. They don't even want to be a bond fund manager. No. They want to go to private equity. Yeah. That's where, that's the sort of, the 1980s Salomon Brothers. Everybody wanted to be at Salomon Brothers in 1980s and be a swashbuckler. That's private equity. 0 rates was it was the gift that kept on giving. And the same I would say in commercial real estate. It was just like, oh yeah, I can buy that 2% cap rate thing. That's fantastic. I'm going to fund at 0 forever. I think those are the 2 places where we just have to. And by the way, I don't think it's macroeconomically a catastrophe. I don't think. I mean, it's hundreds of billions of dollars.
It's going to take time.
That needs to be written down. Yeah. Maybe $1 trillion, maybe a little more. I mean, there's $2.1 trillion in private equity. Not a lot of the losses have been realized, but let's just say it's half. It's $1 trillion over the next 5 years. We have a $28 trillion economy. Yeah. 28.
And by then it's
going to
30.
I'm sorry, it's just not that much. It's 3 or 4% of GDP over a long period of time, and GDP is growing pretty fast. And I think we'll hold, and that's really where the pain is. And by the way, offsetting that, there's a bunch of guys that locked in really low rate liabilities that are living really well because the liabilities that they had that they thought were worth 100 are now worth 80 cents on the dollar. And that's consumers mostly, but it's also a lot of corporates. Yeah. And a lot of the losses, we didn't really talk about this, but my biggest theme over the last year has been that a lot of the losses that would normally be in the financial system because of people who own the assets on the liability side that are marked down, like mortgages or corporate bonds or even government bonds, a lot of those assets ended up on central bank balance sheets.
Yeah.
And we socialized a big chunk of the losses that we've never done before. $1.5 trillion in mark-to-market at the Fed, $1.5 trillion in mark-to-market at the ECB. We would have had to eat that pre-08 without these big balance sheets. That was a huge stimulus that came into the system. And it's going to stay with us. And it really changes the dynamic of what 5% interest rates mean. It doesn't mean the same thing as it used to mean pre-08 because those balance sheets are absorbers and they're liquidity generators as well. And that liquidity stays with you and the loss absorption stays with you. And they really change your fiscal outlook because so much of that debt is permanently removed from the rollover.
Well, I give kudos to you for really disentangling those two things and opening my eye up to it, too, because I was like, well, how can they increase their balance sheet if they're hiking rates? And, reading your piece, I'm like, Dave, what are you doing here? And you're absolutely right. You nailed it, and it's changed my way of thinking. And so I just wanted to thank you for that. And
I appreciate that.
So we read the research, and it helps us formulate opinions. But before we let you go, I know you put some hats on the table. We can put them on for our YouTube as well for the last part of the show. But before we let you go, it's typically Sam's favorite part of the show. So we'll make Sam still listen to it. That's right. What we call Sherman Says. And so, Jeff, you want to give the rules out for Sherman Says?
Yeah, so Sherman Says I'll give you each of you alternating prompts. I'll start with Jeff first and then move to you. Sam says he used to ask for one-word answers. When I listened to the one from 5 years ago, you guys were pretty succinct. So maybe we can kind of keep
Tie it up even more?
Tie it up even more.
Half a word.
Half a word?
It has to be monosyllabic.
Yeah. All right, Jeff, we'll start with you, and we'll go with short end rates.
Penned. For now. For now. But I don't see him moving too much.
All right. Dave, let's go to geopolitical risk.
Always there.
All right.
Penned.
Sam likes to do a lot of these, but having been on the other side, we're going to keep it pretty short.
Okay.
Let's go with U.S. manufacturing.
Resurgence. I think the CHIPS Act is what we're seeing there, too, and I think it has downstream effects, too, where you're seeing it in construction, you're seeing some bigger impacts. And for all the crap the administration gets, I think that's probably going to be one of the best policies that came out of this. Yeah. And I think it's good for our security, for our future. And I tell that to all our clients, too, that don't underestimate that. That's one thing that we need the next TSMC. Although I said if we were to name it, it's going to be the USMC, and I don't want to mess with those people and steal their acronym.
Absolutely.
Yeah.
All right, let's go to services.
Services. Prices a little stickier than we'd like, but eventually coming back to normal.
Okay, good. Let's go to business cycle.
It exists. Don't forget. It will exist, even with all these liquidity.
It
hasn't been canceled. It's not woke. It's still there. And so it's not broke. It's not woke. It's not broke. It does exist. And I think you're seeing it now, too. And again, just because something hasn't broken in the system doesn't mean it won't. And I think, as Dave pointed out, just the risks are to these kind of lowly financed bad businesses. Yeah. And that's part of the business cycle is flushing that out.
All right, let's go to Dave, back to you. Labor market.
Incredibly strong.
Yeah.
Just incredibly strong.
Yeah.
Jolts.
Yeah. Everything.
Yeah, I mean, for as much of the haters out there, birth, death models, whatever, I like to say the one thing, irrespective of how you feel, is go to the unemployment claims. And there's one thing I know about my fellow Americans is that if we get laid off, we're going to go get that check. We're going to get that free money check because we all paid in the system.
Yeah. And they all know how to do it.
And you know how to do it. And, here, Gavin will give them to you. So although one of our analysts says that, well, it's not worth getting the unemployment benefits, you should just go drive for Uber. And I'm like, after working 25 years, maybe I'm going to sit at home for a couple months and not drive to Uber, So anyway.
All right, Jeff, let's go back to you, and let's go with cocoa.
Whew. I can't get my Chalk Zero hot cocoa anymore. It's been discontinued because of that, and so they only sell the Choco bombs that are super expensive. But I have no idea what's going on in cocoa, but it's coming back to reality, and I need prices to come back down because My household just is not as good without that zero sugar hot cocoa mix.
All right. That's why I asked you.
Yeah.
Dave, gold?
China buying. I really believe China is disengaging from the U.S. Treasury market in anticipation of some form of altercation with us in the future. I think what they saw with the Russians and what we did with $600 billion scared them. And I think gold and crypto to that extent have, and commodities overall, copper, the like. I think there's a portfolio of hard assets being built in China that's probably underneath, and maybe equities as well on the side. That's just gonna foreign equities as well. But I think it's really we changed things when we did what we did to the Russians. We changed a little bit of the way the dollar and the Treasury market are thought of.
Well, they were smart to get out of it, too. The Russians were, too, to get out of the Treasury market. And then obviously the sanctioning we did that you're talking about. But, that is the biggest question I get from clients say, what do you make of gold? And I've been scratching my head on it.
Well, it's a huge dislocation with real yields. I mean, you can't explain it with real yields. It's scary. The chart is really scary because it's so long term.
And if you look at it in every other currency besides dollar, it's even worse. Yeah, right. Exactly.
All right, Jeff, last one. Tampa.
Headquarters.
All right. Dave, go to the other side of the state. Miami.
Oh, come on. That's not fair. You're going to compare Tampa to Miami? Dave's winning, okay?
I think Ken Griffin spent his entire half hour at the Milken Institute yesterday talking about why everybody should move to Miami. I was a pioneer in 2016. I'm not sure I would move today to Miami. It's gotten way too expensive, and the infrastructure is not ready for us, Wall Street people. There's kids' schools, golf, beach club. I mean, it's not ready, and the traffic's a mess. There's probably other places in Florida that are of better value than Miami now. It's just gone up so much. But I love being there, and I love having bought it having been there since 16. I'm fully ensconced and love it. But it's a tricky. If you were a young family with kids, it's a tough one. Yeah.
Well, and also I heard about like the restaurants now. You have to be a member just to get reservations. That is beyond New York. So
So I was very excited today to bring you the hat. The hat was a celebration of Jay Powell's successes, and I spent a lot of time, as you pointed out in the last podcast here 4 years ago, telling you why Jay Powell really screwed up in 2018 and why I think he's going to pivot. But I've spent a lot of time trying to talk about why I think Jay Powell actually did an incredible job at managing this inflation shock. What he did in June with the Timorous pivot and the 75s and just anchoring inflation expectations, keeping this curve inverted was really a symbol of Jay's success, I think. More than any recession signal, it was a signal of his ability to tell everybody, we are going to eventually get back to lower rates. You have to take the pain. And that's all in the short end. You got to live with it. You got to watch it go down in 22. You got to hold on and be patient till we get the inflation out of the system. So I made the J with a crown.
Oh, nice.
The best part about this is I'm coming to see Double Line, and I've got two J's here.
Two J's,
right.
and I've got Jeffries on the back. Yeah. So there's a lot of J's to pass out. Yeah. Would you mind a picture of us?
Yeah, we'll put them on for the cameras for the YouTube. This is going to wrap our session on the YouTube. So we're going to go back into hiatus unless Zervos comes back with more gifts. As you may find out, too, bringing us gifts helps get you on the Sherman Show pod. So I want to thank everyone for listening today. Hopefully you enjoyed it as much as we do. Every time we have Dave around, by the way, we have another hour meeting with him after this to really pick his brain a little bit deeper. So thanks, everyone, for listening. It's time for a photo op. So take care, everyone, and we'll speak to you soon.